Hello, everybody. This is Mike Sicarons with Affinity Wealth Management, here to discuss the economy, the markets, and what's going on, and what we think is going to happen going forward. I cannot believe that we are officially one third through the year, and so got a lot of things to talk about. So let's get to it. So, as always, this is for educational purposes only. These are not recommended buy or sell decisions. If you have any questions on how this affects you or your portfolio, please contact your Affinity Wealth financial advisor. Okay, so let's get started with talking about the economy. Now, uh, domestic GDP, real gross domestic product, came in at a 1.6% rate for the first quarter of 2024, which is obviously above zero, but not nearly as strong as it was in prior quarters. And the fear is that the economy might be slowing down. And if the economy is slowing down, what will the Fed do? Will it start to cut rates? Will it not start to cut rates? Is inflation still too high for them to cut rates? So we need to take a little bit of a deeper dive at what the GDP print means in order to really determine about what's really going on with the economy. And so this slide here kind of talks about the percent change from Q4 of 2023 to quarter one of 2024. And what you can really see is that consumption eased, services expanded, investments grew, but the biggest drag was from inventories and net exports. And you can see the net exports number went from a slightly positive situation to kind of a big negative. Now, exports is what's going on, when you send goods overseas versus what goods we're bringing in. The fact that that's weak is not a real indication of what's going on in our economy locally and domestically, but it's something to keep an eye on. With consumption being good, with investment being good, there's more strength than the 1.6% print kind of indicates. And at least under the hood, things look okay as of the moment. Now, the other thing I'll also take into account or also mention is that they revise these estimates over and over and over again. So we just need to kind of take all these numbers with a grain of salt initially and just kind of see after several months what the final number kind of looks like. Now, one of the more what I call market sensitive indicators when it comes to economic health that we look at is the ratio between consumer discretionary stocks like Tesla. These are items that, when these are your want items versus your consumer staple stocks. These are your need items. And when that ratio is going up and to the right, like it was right here, that means that the wants are outperforming the needs, which means that there's a lot of extra economic activity going on and a lot of extra consumption. When it's going the other way, when it's going down like this, that means that toilet paper is winning out over discretionary items. So what you can see here is like going back to January, and this kind of goes along with that GD print, you can kind of see that toilet paper's been winning over the needs have been winning over the wants. But as long as we stay probably above this line, this black line right here, this ratio in the longer term trend of the wants being greater than the needs is in place. And so, although it's not quite as conclusive as it's been in years past, it's still a ratio where they're still showing signs of economic strength. Another kind of market sensitive area that we look at when we look for economic strength or growth is copper. And the reason why we use copper as an economic indicator is because copper is in everything. Copper is in our homes. Copper is in our computers. Copper is in our semiconductors. Copper is in our telecommunications. It's everywhere, and not only domestically, but also internationally. As you see these major infrastructure programs going on all across the world, everyone needs copper. And you can see this triangle here is where copper was when we did our last economic and market update. And you can see the move that it's had from somewhere around 326 all the way up to 468. That is a huge move in copper. That means that there's a lot of demand for copper out there, which means in all probability that there's a lot of demand for economic activity that's going on. So as long as copper continues its upward trend, or at least kind of stays above $4, uh, there's probably signs of good, healthy economic growth. Now, this puts the Fed in a pickle, right? Because they thought that the massive upward swing in rate cuts would bring inflation, or excuse me, rate hikes would bring inflation down, and they would have much, and that it would soften the economy a little bit, and they would have some room towards the end of this year, the beginning, middle of this year, to start cutting rates. Now, the GDP print came out weak, but inflation is still stubbornly high, and I mean stubbornly high at 3.6%, based upon year over year, based upon last month. Now, the Fed's target is 2%, so it's well above their 2% target. But when we do financial plans, we assume a 3.5, 3.6% inflation rate on our financial plan. So to us, that's kind of in line. So, but it does put the Fed, in a pickle, like, maybe having to either stay higher for longer or delay the rate cuts and see what happens with the economy. So Chairman Powell's kind of in a pickle. The Fed is going to have their meeting tomorrow, which will be May 1st. And my guess is they will try and talk hawkishly in order to try and bring inflation down by just their words. Now, one of the things that typically happens historically, and this is what I think the Fed is kind of hanging their hat on, is, and this is more of a monetarist or a Milton Friedman version of economics, is that inflation is purely a monetary phenomenon. I mean, it's generated by the Fed, and that the money supply growth is a determinant of what inflation is, right? So M2 is a version of the money supply. You could see it peaking in 2020, in 2021, and they've been trying to bring the money supply down through a combination of rate hikes, trying to slow economic activity. And you can see for the most part, the CPI has kind of come along down with the money supply. Now, the question is that will it continue to come down, or will it still stay in this 3.5 kind of range going forward? And, you could start seeing the money supply uptick here a little bit, and is the CPI kind of taking that into consideration? So one of the things we'll continue to monitor a little bit is what that inflation rate looks like and what the Fed is going to do. Because one of the things that the Fed is also considering is obviously mortgage rates. Mortgage rates have been, for this year, somewhere between 7 and 7.5% for the most part on a 30-year fixed mortgage. Although historically, that is probably a normal mortgage rate. I know many of you who are watching this right now remember their first mortgage rate of 14%. When I purchased my first home, mortgage rates were at 9%. And I remember one of my best friends, when I first started working, he had bought his first house and he was so excited to get a 6.5% mortgage. So, although we've had this rapid rise off of these near zero interest rates, or 2 and 3% 30-year mortgage rates, it's still within the norm of history. Now, maybe the new normal especially for the 2000s have been, in this 3 to 4% range, and maybe that's the new normal going forward. But when you go back farther, you go back to the 60s, a 7.5% 30-year fixed mortgage is kind of normal. So, and it really hasn't dried up. Housing prices are still stubbornly high. Now, that might be due to a supply issue, and we're going to talk about that on the next slide. but it hasn't really slowed down housing activity yet. Now, one of the good things that might start to either help bring housing prices down to a more reasonable level, especially if you're a first-time home buyer, is the fact that economic activity and the investment in residential real estate has gone up 3 quarters in a row after 9 straight quarters of going down. We actually, believe it or not, I believe, have a housing shortage in this country, where the home formations that are going on, whether it's due to marriage or just people leaving their parents' houses. So household formation is increasing at a rate greater than real estate formation. But hopefully, the supply will start to catch up with what the demand is, and we'll get some sort of equilibrium here. But in the meantime, I know if I walk around North Wilmington, or I'm in North Wilmington, I look for real estate. There aren't that many houses for sale right now. Now, that could be due to the higher interest rates. That could be due to the lack of supply. That could be due that people just love their homes and don't want to move. There's all sorts of reasons why. I try not to get into the whys. I just kind of look at what is. Um, but we're starting to see housing investments starting to tick up again, which is good again for the economy, and it's good for households in general. Now, to raise or not to, or excuse me, to cut or not to cut, to stay where we are or not to stay where we are. Um, One of the things that Fed always looks at is how it affects the banks. Because one thing they don't want to do is they don't want to create a financial crisis circa 2007 through 2009. Um, and so one of the things they look at is what's the financial stress index, or what's the stress that's going on in the banking system, and how much leeway does that give them to be able to take the correct monetary measures in order to keep, to meet their dual mandate of stable prices and economic growth. Well, as long as we are below this line, that means there's little to no stress in the financial system, which is good, which means it gives the Fed some leeway to take a maybe more accommodative financial arrangement by cutting rates from this perspective, inflation side. So no real stress in the financial indexes. Another measure of financial stress in the banking system or in the financial system is the ratio between high yield bonds, which we use the high yield bond ETF as the proxy, and treasury bonds when we're using the 7 to 10-year treasury bond ETF as that proxy. I love ratios. Everyone knows I love ratios. When this ratio is going from the bottom left to the top right, that means that high yield bonds are outperforming treasury bonds, which is a risk on sign, which means that there's not a whole lot of stress in the financial system. You can kind of see this little blip right here is Silicon Valley Bank. This is obviously COVID, when there's a lot of stress in the financial system because there was zero economic activity. So again, and here we are up here, again, moving up and to the right. So again, this is a good signifier of a healthy financial system, of strong, of at least moderate economic growth. And again, it gives the Fed kind of the all clear sign to kind of do some things if they need to keep the economic growth kind of either going and or cull or bring down inflation. So shifting gears from the economy, I guess the summary is that the economy is still growing, although not as strongly as it was in 2023. But those numbers tend to be revised, and that the market sensitive economic indicators are strong. So let's talk a little bit about the markets. So first quarter, I know we're 1/3 of the way in, but let's talk about first quarter for a second. The first quarter story was the bull market in the S&P 500, in artificial intelligence. Bitcoin made a roaring comeback, and then quietly in the back there was gold. And gold slowly is started to peak towards its 2011 highs, and breaking out of it basically almost a 2011 to 2020 13-year base. And some people might say that Powell's the reason why these things are going on. the anticipation of rate cuts and quantitative easing restarting again, or it just could be that there were more buyers than sellers, and that drove the prices higher. I tend to be in the latter camp. So let's talk a little bit about the economy and excuse me, the markets, um, because although first quarter was strong for the markets, I think this is how a lot of people feel. Maybe it's not keeping you up at night. There's only been one time in my life when the market kept me up at night, and that was back during the time of the financial crisis. Um, but our brains trick us, and if you watch a lot of TV, which I don't recommend doing, especially when it comes to financial news, um, you know, every blip in the market is either a sign of euphoria or the apocalypse. And obviously, fear sells more than euphoria. So uh, obviously, there's a lot of doomsayers and naysayers out on the financial talking TV. And this is everyone's fear: is when is the bull going to turn into the bear, and what do we do? So we're going to talk a little about what we're seeing uh, from the data perspective, not necessarily the opinion perspective. So this is an internal kind of source that we use. As everyone knows, we rank the 6 major asset classes on a monthly basis: U.S. equities, international equities, commodities, currencies, cash, and fixed income. Now, and basically consider them like teams, like, domestic equities being the Yankees, the international equities being, I don't know, the Braves, commodities, whatever. You get the idea. And what happens is on a monthly basis, we have all the players play against each other and we rack up the number of wins. In this case, it's who has the strongest relative strength. And domestic equities is number one as of right now. International equities number two, although very close behind, is commodities. These are typically what we would call risk-on asset classes, meaning that when there's a bull market, these three tend to be in the top 3 spots. And that's what we currently have right now. So on an intermediate term basis, even though the market during the month of April sold off and could continue to sell off, quite frankly, the intermediate term kind of trend is the markets will be going higher. Especially when you have the risk off assets, cash, currencies, and fixed income being in the 4th, 5th, and 6th spot. So this is a pretty crystal clear situation where, as of the moment, remember this is just a snapshot in time. As of the moment, the risk on assets should outperform relative to the risk off assets. Now, when it comes to all these data points, Marty Zweig and his investing rules, I read these at least once or twice a year, and I thought it'd be good to share here as we go into the rest of kind of talking about the markets. Is his number one rule is and I highlighted the 2 most important ones, I think, although they're all important. The trend is your friend, don't fight the tape. So basically what that's saying is that if the market's going up, don't think that the market's going to go down just because. you know. And then number 6 is don't fight the Fed unless it's an opposite of number 1. So trend is always your friend. That means price and price momentum is the number 1 thing he looked at when it came to picking an investment, and all these other things kind of apply along the way. What I love about his rules is that it kind of gives us a framework on how to manage risk, and also make sure that we're taking our emotions out of a investment process or investment situation. But so let's look at some of the trends that are going on in the market currently. So all of you know I like video games. I played a lot of video games when I was a kid, and this is kind of like the cheat code around the S&P 500. So this is a monthly chart. So every one of those little lines, gray lines means that the month was positive, red lines means the month that is negative, of the S&P 500 returns going back 20 years, so back to mid-year of 2005. And the blue line that's kind of here is the 250-day exponential moving average. So a long-term moving average. And typically what happens is, and if you look at the numbers, it works out quite well. When the S&P 500 is above the blue line, markets tend to do well, and you should be invested. If this was a binary world and this is the only thing you look at. if you're below the blue line, you should probably not be invested in the S&P 500. And you can kind of see here going back to, probably mid-year 2022 when the S&P got above the blue line, and we are now well above the blue line, and you can see 4678 is where the exponential moving average is, and the S&P is somewhere around 5100. I don't know exactly how it closed today, but somewhere in that range is we're still well above the blue line at the monthly close, which means that all things being considered, the trend is still in place for the longer term bull market that's been going on. A little bit more shorter term, you can kind of see this. The second blue line is where that exponential moving average kind of plays out. But there's a first set of support here at around 4,800, and then second set of support at 4,600. And like I said, April is not kind to the S&P. After a great first quarter, first quarter really going back to October through first quarter. Then April's not been as good, but that's okay. We expect corrections. Corrections are supposed to happen. They're supposed to be healthy for the market. When things go up in a straight line, they tend to go down in a straight line. So having a little bit of volatility to the downside is actually not a bad thing if the trend stays in place. And so far, so good. And as a matter of fact, now it's funny, I tried to find an updated version of this slide, but I couldn't find one because no one wants to talk about volatility and downdrafts in a upward moving market. So they don't like to talk about it in bear markets. So this is a slide from 2022, sponsored by First Trust, basically showing market returns going back to 1980. And the maximum drawdowns in any given year. So even in the best years, think of like 1980, 28% or 26% return, 17% downdraft in that year. So even in the best of years, you're going to see some bigger declines than you really expect. So, and as a matter of fact, you should expect a 5% or more decline about 3 times a year. A 10% or more decline about every 16 months, a 15% or more decline about every 3.25 years, and about every 5 years, you should expect a 20% downdraft in the market. So again, these things are relatively normal when they occur, and it doesn't mean that a 20% decline is going to turn into a 50% decline. As a matter of fact, the 50% declines are the ones that are rare, not the 20% ones. And so that's one of the reasons why, when we put together strategic allocations, that, we're not looking at every, 5% move in the market. We have no idea where the next 5% is going to come from. We don't know if it's going to be up or down. But if the trend is still in place, we want to take advantage of those downdrafts. So if you have extra cash, for example, you might want to invest that money. So the next few slides are by JC Peretz and All-Star Charts, and my head is in the way here a little bit, but these two are also saying yes. And what these are is like, okay, he has some indicators on whether something's a stock market correction or something more sinister, right? And he has these different metrics that he looks at. And for the S&P 500, 5 of the 6 right now are positive, meaning that they're doing what they're supposed to be doing. So as of right now, it's basically looking at in the current situation, a stock market correction, and not something that is worse. There is one negative here out of the 6, and that is the percentage of S&P 500 stocks above their 50-day moving average. They like to see it greater than 30, and right now we're at 28%. So pretty close from almost turning that no into a yes. And this slide was done in the middle of the month of, I think, April 15th. So even at this stage of the game, if I went back and looked at their indicators, this might actually be a yes now too. Now, a little bit on a bigger scale, so not just looking at the S&P 500, looking at the NASDAQ, looking at other indicators, is the bull market still intact for risk on assets? And, you get a 6 out of 9, which is pretty good, right? The ones that are kind of on the no side here is the percentage of global markets above their 50-day moving average, right? That's on the lower side, but that's been going on for quite some time. I think this one's been no for quite a while. Maybe it got above a little bit 2023, but domestic equities have been outperforming international equities for almost a decade. So, really, even going back to 2009. At some point, that'll change again. From 2002 to 2009, international equities way outperformed domestic equities. There will be a rotation at some point. But right now, U.S. equities are still kind of leading, and that showed in our 6 asset classes. But the big ones is like new highs minus new lows. Like right now, we're not getting a whole lot of new highs, and new lows are starting to creep up. Not at a ridiculous level, but it's something again to keep an eye on because even if the markets hold up, we want to see what's going on under the hood because eventually the indexes will catch up to what's going on at the individual stock level. A great example of this is that during 2008, the average stock actually bottomed in November of 2008, even though the indices didn't bottom until March. So one tends to lead the other. So we just need to kind of keep the new highs and the new lows kind of on our radar. It's not a top indicator, but it's something that we do look at just to see on a month in, month out what is going on underneath the hood. But again, still lots of bull market behavior out there. And this is one of the key ones that they looked at, that risk on versus risk off indicator or ratio. Me and my ratio. So the things that make up their risk on indicator are copper, high yield bonds, the Aussie dollar, semiconductors, and high beta stocks. And the risk off indicators are gold, treasury bonds, Japanese yen, utilities, and staples. And again, we had a big move off of COVID where we went risk off, risk on, kind of treaded sideways for, about 18 months or so, and then we broke out. So again, risk on, and now we're kind of hanging out up here. So we'll have to keep an eye on this, but right now the risk on indicator is certainly a positive for overall long-term or intermediate term market performance. Uh, but it's one of those risk off indicators. One of the things I talked about is that stealth bull market in gold. Gold has been, the price momentum in gold has been quite strong this year. It's one of the best performing asset classes right now. And, potentially it could continue. If it breaks out above its 2011 high, that's a 14-year base that, the measured move could get as high as 4,000. But, just like anything else, it's got to get above that 2011 high. There's no guarantee of that. It took a long time to get to where it is now, but gold is an interesting place to take a look at. Because on a pullback, even a pullback all the way back down to this black line here, which has kind of been the resistance over the last several years. Looking at gold and gold stocks is something that might come into play. Remember, I said commodities are one relative strength point behind international equities right now, and it's been the fastest mover over the last several months. Also, we talk about the lifeblood of bull markets being sector rotation. This is a ratio between energy and technology. And you can kind of see here energy reasserting itself. Energy was actually the number one performing stock asset class in quarter 1. So commodities have kind of made a turn here during 2024, and maybe we don't know for sure yet because technology is still performing well, right? Just because the ratio has energy outperforming technology doesn't mean technology is not performing. I mean, look at the price of Nvidia or Microsoft or some of these other tech stocks. They've also performed very well this year. It's just that the ratio of energy stocks are outperforming relative to technology currently. Is this going to continue? Is this rotation continue to happen, or is technology going to take its leadership place over again? It's to be determined, but it's something that's interesting to me that we need to take into account when we're looking at what we should invest in. Now, one of the themes I've been, doing these presentations for the last several years, and one of the things we've been talking about is the correlation between the US dollar and stocks going back really to about 2016. So that's about 8 years ago or so. And when the dollar is strong, stocks tend to be weak. And when the dollar is weak, stocks tend to be strong. So I showed this presentation back, these slides back in October of 2022. And when I said that, magazine covers are the best type of contrarian indicator because they're always late to the party. And they're talking about powerful greenback. The dollar had hit an all-time, an intermediate term high here. And I said, as soon as the magazine covers get into it, usually it's an opportunity that the opposite's going to happen, and that's exactly what happened. So along with some other confluences, dollar sold off, market got stronger, and and when the dollar's done well, like last summer, markets sold off through October. August, September, October were kind of rough last year. And then got up to about 105, 106 in the dollar, and then the market and then the dollar sold off and the market started doing well again. Well, the dollar's been strong in April. So the question is it going to continue this strength to start approaching these numbers up here, which would be if the correlation continues, or the inverse correlation continues, it would be bad for the market, or is it peaked out kind of based upon what happened in October-ish of 2023? So to be determined, it's again an indicator that we really like because it is very uh, as long as these correlations hold, it's a pretty good indicator of what the short-term performance of the markets are going to be. Now, this is my favorites ratios, and it's going back to the dollar versus the S&P 500. Again, dollar strength shows weakness in the market, dollar weakness, strength in the market, and then again you see this spike here in April. So again, something to keep an eye on going forward. So I saved best or probably the worst for last. My least favorite thing to talk about is what's going to happen with this presidential election. And the question we get every day is like, what's this election going to do to the markets? What are we doing to position ourselves? And depending upon your point of view, do we need to sell everything or do we need to buy everything? So we've done, the last 3 years or 2.5 years, we've done several discussions on the 4-year election cycle and how markets have done during the 4-year election cycle. So just to give you an idea, the gray line here, just to kind of reiterate, is all the election years going back to 1950. So there's been 18 of them. And the average market return in that 4th year is about 7.3%. If you combine them all together, and there's been 18 of them. Now the blue line is, and there's been 13 instances of this, it's the election year performance when the previous year had a greater than 10% rate of return. And you can see in those election years, the average rate of return was about 10.5%. So last year, the market was up quite a bit, well more than 10%. So if history is any guide, we should see somewhere, if the averages hold, somewhere around a 10% rate of return this year. Now let's look at what is actually happening this year. So historically, every election year, going back to that 18 again, those 18 election years, this is how, if you do a composite of all of them, this is typically how the market kind of performs in that year. This red line is what normally, or what's happening this year. And you can kind of see that the market got off to a straight shot and now it's starting to come back. And ultimately, we'll see, does it fall back into this box by June? Does it stay above this box? Is this the outlier where it goes up and then straight down? To be determined, but like I said, history, has a tendency to rhyme if it doesn't repeat itself. So if we use history as any guide, and we should always use it as a guide, not as a rule, that the year should still turn out okay. How we ultimately get there, TBD. But the market will based on all the other indicators we're looking at so far, should be okay. Now, I'm going to go into some presidential history here. Again, not my favorite thing to do, but I think it's important for people to see that this is the compounded annual growth rates of the S&P 500 when there's a Democratic or a Republican president. You know, the average rate of return is higher for Democrats. The median return is higher for Republican presidents, and you mush those two together, and it's basically a wash. Um, and then I got this slide from Peter Maluk, who is a financial advisor out of he just wrote a book, and he's a financial advisor from the Midwest, and he got this slide basically looking at all forms of government. So when there's a Republican president, when there's a Democrat president, when you have when the Republicans own all three houses, when the Democrats own all three houses, when there's divided government, et cetera, et cetera, et cetera. And realistically, it doesn't matter. The returns are basically the same, and quite frankly, over time, all the returns are pretty darn good. So if you're investing based upon who's going to win the election or who's not going to win the election, you're going to be costing yourself probably money if history is any guide. And that's why, uh, you know, uh, having an emotional reaction to a presidential election when it comes to your investments, is not the best way to secure your financial future. And no matter what happens, right? Markets, go up, they go down. But whoever's in office, if the markets are going up, they're going to take credit. And when the markets go down, they're going to blame the other side. So a little bit of humor here to end the day. On the presidential cycle. I don't know what's going to happen. I don't know who's going to win the election. I do know that the markets have a tendency, more or less to go up over time. So regardless of who's in office, and I think that's the key takeaway going forward. Could this time be different? For sure. Is it going to be different? Probably not. So with that, I want to thank everyone for coming and listening to our presentation today. I hope you enjoyed it. And obviously, if you have any questions, more than happy reach out to me or your Affinity Wealth financial advisor. If you think there's anybody who'd be interested in seeing this presentation, please, you can send them the link when we send this out. So I hope you're well, and I really appreciate everything that you ensuring your faith and trust in us, and we'll keep working hard each and every day for you. Thanks. Bye.